Ever felt like your business profits could be higher if only you could manage your taxes better? Effective corporate tax planning is essential, not just to comply with the tax law, but to enhance your business's profit margins. Let's dive into strategies that could save your business significant amounts of money each year.
Tax planning is an approach by taxpayers to take advantage of any loophole in the tax law. So any scheme, any arrangement, or any way that a taxpayer, consider a transaction, either for one-off transaction or continuous transaction, to ensure they pay the minimum possible tax or to avoid tax as much as possible within the law. It is referred to as tax planning. Some tax planning can become tax avoidance, some can be outright evasion. When it is evasion, it is criminal. Okay? When it is avoidance, it is allowed. But the expected provision that is being put in place, even when you have tax planning that are pure avoidance, that are not illegal, the tax authorities still need to be informed. And some form of tax planning now are considered in some jurisdiction, which is what Nigeria is also going into, as being aggressive. When tax planning becomes aggressive, it is tending towards evasion, and it can be termed as illegal. Okay, so on the surface, tax planning is not illegal, except where it is solely and desperately to avoid or evade tax. Avoidance is not illegal, evasion is illegal. But like I said, depending on the extreme that you go to, the tax authority can be offended, and then the person may risk prosecution, even for avoidance.
Corporate tax planning involves understanding and applying tax laws to minimize liability while maximizing profitability. In Nigeria, businesses are generally subject to a company's income tax rate of 0% for companies whose annual turnover is 25 million naira and below, 20% for companies whose annual turnover is between 25 million naira and 100 million naira, while those whose annual turnover is 100 million naira and above pay companies income tax at the rate of 30%. But there are strategies to manage this. One crucial strategy is utilizing all available tax deductions and allowances. Deductions relate to certain allowable expenses that you can subtract from your gross income before tax is calculated. Expenses that are wholly, exclusively, and necessarily incurred in the generation of company income are deductible. These include costs like advertising, legal fees, and even some types of insurance. Timing can also play a pivotal role in your tax planning. For instance, accelerating certain expenses within the current fiscal year can provide immediate tax relief. Conversely, deferring income to the next fiscal year might push some profits into a period with potentially lower tax rates or allow for more strategic planning. Depreciation is another area where strategic decisions can impact your tax bill. Opting for an aggressive depreciation method can increase your expenses on paper today, providing tax relief now rather than later. However, it's important to balance this with the long-term financial outlook of your business.
Tax planning depends on what you are looking at in terms of a particular transaction or your wholesale transaction for the year as an entity. All right, so when you talk about tax planning, you are looking ahead as to this transaction I'm going into. How best can I structure it to minimize my tax, either in the immediate future or in the long run? You want to see what tax advantage can I take? What relief is available as far as this transaction is concerned that I can incorporate into this transaction that I'm going into to limit or minimize my tax exposure, either by deduction at source or relating to stamp duty or relating to value-added tax payable, or even the corporate income tax SITA liability that may arise from such a transaction. You are constantly focused on the implication of those transactions of the tax implication on those transactions. That is tax planning. And for example, if a company is going into the acquisition of a property for the purpose of property letting, you want to look at what capital allowance can I claim? Is it possible to avoid withholding tax deduction? Can I enjoy pioneer status on this type of transaction? Am I going into a tax haven, or should I set up a company in a tax haven? Do I go into a free trade zone? Okay, that is another type of tax planning to ensure that you are not exposed to any tax, or that the tax exposure is limited. So there are so many ways of doing that. As long as you try and do it within the law, then it is an acceptable tax planning. And the tax authority is definitely coming forward with a provision that require taxpayer to disclose any tax planning scheme that they have in place before they implement it.
Moreover, structuring your business efficiently can lead to substantial tax advantages. For small businesses, choosing the right business entity, whether it is a sole proprietorship, partnership, or corporation, can have significant tax implications. Every business's situation is unique, which is why it is crucial to tailor your tax planning strategy to your specific circumstances. Engaging a knowledgeable accountant or tax advisor who understands both your business and the complexities of Nigerian tax law is invaluable. Effective tax planning is about more than just saving money. It's about making smart decisions that drive your business forward. Embracing the strategies ensures that every naira you save on taxes is a naira that can be reinvested into growing your business. Empowering yourself with the right knowledge and strategies is the first step towards maximizing your profits through informed tax planning. Don't forget to subscribe for more insights that help your business succeed. Drop your questions or share your own tax planning tips in the comments below. We love hearing from you.